And welcome back to Yuri's Box. In this video, I'll be talking about TLT and the S&P 500, the week ahead. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So we do get a couple of interesting data points this week. We start off tomorrow with durable goods orders. I would mainly pay attention to non-defense goods, ex-air, especially ex-air. You would like to kind of seep through any Boeing shenanigans, that can skew the especially the headline number one way or the other. So that would be interesting to see, how durable goods orders come in for the month of April. We do get another read on consumer confidence now from the conference board. Are expected to rise at 87.2. Trading Economics actually has a forecast for 84. It'll be interesting to see how this number holds up. Again, the idea is that in May we kind of walked back the worst case scenario, meaning we said we were going to cut a limb off, and we walked it back. So now we're celebrating the fact that we don't have to lose a leg. I.e., we walked back the 150% tariffs. We're down to 30, which isn't good, but it's not 150%. So I wouldn't be surprised, actually, if we do see a rise. But again, I was expecting the same thing on University of Michigan Consumer Survey, and we actually got a miss on that read. So it'll be interesting to see where that comes out. Same thing for Dallas Fed manufacturing index. I've been going over these quite consistently as they've been published. Last month was not great, to say the least. It'll be interesting to see how things have held up. And again, I come back to what I said before regarding consumer confidence. The fact that we walked back the 150% tariffs could help, boost confidence in the short term. So look for that as well. Moving on to Wednesday, we have another round of regional Fed reads on manufacturing and services with Richmond and Dallas. We actually also have the Fed FOMC minutes, although I'm not really too keen on a Fed speak, as you already know. Moving on to Thursday, again, GDP data will be interesting, but what I'll be paying most attention to is really the initial jobless claims, for the simple reason that one of the main calls I made in my when I first started making videos, that is that we would basically follow the exact playbook of 2024, where you have a bottom in initial jobless claims in January, more or less, and then you slowly grind higher towards the summer. And again, that's basically what we've seen so far. We've bottomed out around January, slowly grinding higher. And, we're still hovering around the 230 region, which again, the way I kind of treat initial jobless claims is that if you get anything below 215, you can generally expect the unemployment rate to either not move or even shrink, all right, just pop lower. If, on the other hand, you see anything above 220, 225, that region, you can usually expect the unemployment rate to move up as a consequence of that, all right? And the fact that we've been hovering around 230, around 230, that is, having the last read at 227, to me, just implies simply that we might see a 0.1% rise on the unemployment rate. But again, that is a topic for next week's video. As far as keeping specific to initial jobless claims, the next read is expected to come out at 230K on initial jobless claims, which would keep us still hovering around the 230 region. Now, initial jobless claims usually have a habit of spiking higher and then just coming back down. What is interesting, and again, I'll try not. Again, I'm telling myself more than more than you, the viewer, not to extrapolate too much out of what I'm about to say. But what is interesting is that if you actually compare this year's reads compared to last year's, you'll notice that again it's just ever so slightly higher. The week for May 12th, for example, right here, we're at 216. All right. What was this right here? April 21st. Right, we were at 209. Okay. So again, it's depending on the data point you get, which week you're comparing. It can get more severe or less severe. Regardless, you get the point. I mean, we're starting off at a higher, starting point, if you will, and we keep on grinding higher. And I've always pointed towards the summer as, a time where, you could see something a little bit more, pernicious perhaps in the initial jobless claims read. But again, this is getting way too out there. Again, next read is expected to come out at 2:30. Same thing, continuing jobless claims. Expected to come out at 1.9 million, slightly above for trading economics. Regardless, that would put us basically right around here, basically at the cycle highs, really for this cycle right here. And again, my base case really is that this to me just reeks of, if you will, consolidation. I'm not going to dare perform any technical analysis on continuing jobless claims, but again, just looking at it, to me, it just reeks of consolidation and then eventually breaking out. And again, I wouldn't be surprised if, by, I don't know, September, we're anywhere between 2 million and 2.1 million. But again, regardless, the fact that we continue to hover around the 1.9 million range just tells you that if you have a job, fine, great. But if you lose a job, it's getting harder and harder to find a job. All right. And the fact that continuing jobless claims continue to hover around these local highs is just a further indication that, again, if you lose your job, it's hard to find a new job, immediately. Okay, so keep an eye on continuing jobless claims. It'll be interesting to see these two data sets come out and see how they land. What else? Well, on Friday we also have PCE. Now, PCE should be a somewhat cool read, given the fact that we've had PPI come in cool, we've had CPI come in cool. So again, it'll be interesting to see how the Fed's preferred inflation data prints. And that's pretty much it for the week, really. That this is a topic for next week's video. So again, how could these things affect TLT? Starting with TLT. Well, again, if inflation comes in cool, that would be a good thing for TLT. Now, I know I've been saying this about inflation being a good thing, coming in lower, being a good thing for TLT, but bonds really don't seem to care at the moment. And again, I've spoken about this before, I've addressed it before. If you ask me, you kind of have this dynamic, this duo between the dollar and bonds, where perhaps the dollar is pricing in, slightly lower growth in the US because of, all of the events, all right? And bonds doing the heavy lifting on the inflationary side. So I don't agree with this trade. I don't think that it is the most likely outcome, but the market right now is discounting a stagflationary outcome. Now, again, I've generally faded that view, and I continue to fade that view to this day. But if you ask this schmuck with a YouTube video's opinion, that's pretty much it. So again, if inflation were to come in cooler via the PCE read on Friday, at this point, don't expect TLT to cooperate. That is, eventually, what I think will matter to TLT is something like the non-farm payroll report. And I know I'm getting a bit, too into the future here, but let's just say, ignoring unemployment, if let's just say we get an okay read on non-farm payrolls, that could also fuel, something we've been talking about for, since I started making videos, that we finally get the sweep of the previous low. So perhaps you go down to 80 on the week of non-farm payrolls. And then it's kind of like a fake breakout of this falling wedge, if you will. And again, usually the first breakout of a formation is usually the fake out. Not always, sometimes, usually. And then you get the real one, which could or may or may not be, the way it plays out. But again, it's just something to think about, given the fact that right now everybody seems, hell-bent on, on inflation. And again, it's a form of what I've been calling inflation PTSD. And who knows, maybe consensus is right, but, I'll generally take the under at this point. I think that inflation has run its course. Not saying that it'll be a non-factor. Not saying that. In fact, if you've been watching my videos, you'll know that I've explained many, many times how I think inflation will affect things. It's just that at this point of the cycle, I think that we're at a point where, you should be a little bit more concerned on growth. And given also the fact that we are trading at the lows on bonds, I think that is generally, the right thing to do when, navigating the markets. That is, unless this is something completely different. Unless this is a totally new regime, and we get something that is totally new. Again, that is not my base case, but that's the beauty of markets. It's where opinions get put against one another, and whoever's right calls Forbes and rings up for the interview. But again, so that's pretty much it for TLT. The main event, I would think, would be PCE. But again, don't expect too much drama out of it, because again, bonds seem hell-bent on, pricing in this upcoming inflationary, rebound in inflation rather. So as long as the bond market is, having fun with that narrative, don't fight the bond market. And if anything, just wait for more favorable prices at that point. Again, as I said before in my previous videos, the way I'm operating is that this kind of parallel channel that I had before is broken, and I'm just expecting TLT to bottom around $79 to $82, something like that. All right, I'll gladly be proven wrong. All right, but again, that's pretty much it for TLT. On the S&P 500 side of things, today we also had some good news on tariffs. And again, we had a call between Trump and Ursula von der Leyen, which was quite constructive. They extended, the negotiating period up until July 9th, if I'm not mistaken. And so we walked back to 50% tariffs. Hooray. And again, just to reiterate, that to me, that 50% tariff was kind of a lower high on the craziness scale compared to April 2nd. And again, that is basically, I think, what happened really. So that is why you're seeing, this pop in a small pop, really can't call it a pop, but regardless, a small uptick in 1.25% rise on the S&P 500, mostly due to that. Now, again, I've been cautious all the way, from here till here, and I still maintain, this cautious outlook on stocks, for the simple reason that one of the reasons why I believe that we could could have seen some, follow through on this of this rally right here is that again, all we were getting was Q1 data, right? And Q1 data was filled with goodies because we were front running the tariffs, and we still didn't really have any bad things, boogeymen, baked into the come into the scenario, on the scene rather. And so, among other things I said, again, there was this idea that, we could see some follow through on stocks. And, generally speaking, I said, if I'm not mistaken, anyway, between 5,700 and 5,800, we actually went up to 5,900. All right. Could this be just a dip that needs to be bought? Same thing I said with Bitcoin. Absolutely. All right. But again, I just can't help myself and, remind myself and everyone that the problem that I see with stocks is that soon we'll leave Q1 data behind. And in fact, what we're getting right now is kind of the first batch of Q2 data. And Q2 data is kind of, an evil concoction of of various things that occurred in in these wild weeks. So we don't really have the good news of Q1 to fall back on. All right. Earnings could look a little bit more murky, if you will, simply because again, Q1 didn't have all these events, like tariffs and, some kind of fiscal consolidation, all the goodies that we've been talking about up until this point. So again, I see this transition bit from Q1 to Q2 as potentially problematic for the S&P 500. But yet again, I continue to remind myself and everyone that just because, data might be bad, earnings might be bad, that still isn't a good enough of a reason for stocks to go down. All right. The example I often talk about is the DAX. Look at the DAX. If I told you that, and again, I know Germans, the stocks that are listed on the DAX aren't a perfect representation of the German economy, granted. But if I told you that in 2022, Germany got its entire economic model flipped on its head because, again, they were importing, basically, they were flooded with cheap Russian energy. And, they made that, they used energy to make, all sorts of goodies, cars, they would export that to the rest of the world. And actually that would use to keep their, costs down. That got blown out of the window with Ukraine war. You still have some rising tensions with China, and exports to China on the auto side, with all the BYD stuff is not looking too great. If I told you all of that was happening, would you say, oh well, obviously German stocks are going to go up? Well, your initial reaction to all of that, to the economic model being flipped on its head would be, German stocks are going to collapse because the economy is going to go down. Not what happened, all right? And the reason for this is quite simple. Stocks behave one of two ways, all right? We either have to price in a recession, all right? The sky is falling. It's the end of the world, a la 2008, all right? And we have to go down 50%, 30, 40, 50%, whatever it is. Or scenario number two, it's not the end of the world. We have nothing to worry about, and we can go up, right? Until we don't have anything conclusive that is smacking us in the face, don't expect anything too dramatic like a 30% decline or 40% decline. So keep that in mind. But again, would I ape into the S&P 500 at these levels? Again, I think the time to ape into stocks, as I said before, was October 2023, October 2022, March of 2020, right? Now, that doesn't mean sell everything, go hide in a bunker with canned corn and canned tuna. Absolutely not. But with stocks at all-time highs, And my personal bias is, again, bonds, all right, being at practically at all-time lows. I mean, we're not far away from that, given also where we might end up going. I mean, to me, it's, I've laid out the game plan many, many times before. So can stocks go up? Absolutely. But, as far as the S&P 500 is concerned, this to me isn't really that appealing, given everything I've been talking about. And given also the fact that Q2 data will start rolling in, and at best case scenario, it's not as bad as everybody thinks. Realistically, I would expect some, companies to take at least some kind of a hit, right? So keep that in mind as well. That is pretty much it, really, for this week. These are really the things to keep in mind, in my opinion. Again, pay attention to headlines, as again, we are an incredibly headline-driven environment. Again, I'll say something that I haven't said in a while, but the irony of this all is that everything that has occurred after April 2nd, the irony of it all is that this could end with a post on Truth Social, right? Trump comes out, he says, took some Vicodin, I took whatever, because I'm watching Dr. House, so that's the first thing that popped in my mind. I had a dream, I had whatever, right? I hate tariffs. It all goes away, all right? And that would clear the way. That would make me definitely more constructive on stocks and less constructive on bonds. All right, so that is the irony of it all. It's really in the hands of whatever Trump really feels like posting on Truth Social. Keep that in mind. Watch out for crazy headlines. Try to be disciplined when using leverage, given the fact that we know that a headline could just shellac you in a direction or the other. If you're short, Trump comes out and he says, I hate tariffs, I had a dream, it's all nonsense, free market, baby, this market rips, and you get caught with your pants down. Same thing, you go all in on the long side, and Trump says, you know what, I just want to crash the market because I'm bored, I'm feeling a bit nihilistic lately, so let's crash the market, and just tanks, and again you get caught with your pants down again. So try to be disciplined, in my opinion. This isn't really the time to be a hero. The time to be a hero was back in October 2023, in my opinion. The people that are getting in right now, in my opinion, are people that probably weren't in this far, and so now they have to get in. All right. And potentially, buying in at 5,700 is still better than buying in at 6,100. So, so those are really my 2 cents. Hopefully you enjoyed this video, and I'll see you next time.